Today, we're talking about power laws and how they affect investing and business and just general life. So I encountered a video last week that got me rethinking the Pareto distribution. Caleb, are you familiar with the Pareto distribution?
From the video, yes.
But you have not encountered it previously?
No, I hadn't.
So the Pareto distribution is oftentimes associated with the 80-20 rule, that 20% of people or of a sample get most things done. But it's actually significantly worse than that. It's like, it's not exactly 1 over X, but it's, like the square root of the value actually produces all of the output, which is where you encounter it in work life. But the video kind of talked about how a normally distributed sample size will have like a mean, and then it'll have just as many probabilities on one side as it does on the other. A Pareto distribution, however, isn't that way. As you approach some value, it's almost infinite, and then it has a super long tail going off into the horizontal infinity. So the Pareto distribution, specifically, the guy that made it was measuring incomes. And so it was like almost everybody made some income on the lower end of the spectrum. But as you went up, there were high income earners. And so at the very end of the distribution, you've got people that are making 100 times the standard worker, 200 times, 300 times. And the crazy part about a Pareto distribution or a power law, which I had never heard it referenced to, but it's that geometric curve, is that the weird thing, you've got a power law when you're taking samples and your average will kind of fluctuate and then go up and then fluctuate and then go up and then fluctuate and then go up. And you never kind of coalesce around a number, because the more samples that you take, the more likely you are to include one of those astronomically large numbers. So until your sample size gets to be close to the population, your average always increases because you're always adding in one of these crazy events. So anyway, they took that and talked about how power laws are found in different parts of nature and of life, and likened it to self-organizing criticality. So have you heard the Yellowstone fire story?
No, I haven't.
So with Yellowstone and with other parks, at one point we had a goal of not allowing any forest fires, because there'd be lightning strikes or whatever. A dumb camper would light something on fire. And sometimes we would get these big fires that would take out a bunch of trees. And so our goal was, well, let's try to put these fires out super aggressively. The problem is, so like in California with the redwoods, I think it's the redwoods, their seeds need a certain amount of heat to actually propagate well. And so having a forest fire is like part of their propagation cycle.
Wow.
So they do need it, it seems, to propagate normally. But also what ended up happening is that there would be these fires every now and then that, since we hadn't cleared the underbrush and hadn't gotten rid of trees, would just burn massive amounts of forest. They'd turn into runaway fires so quickly we couldn't keep up with them. Because we hadn't let little fires appear, we had created just this gigantic matchbox that would engulf flame. There's a book called Playing God in Yellowstone National Park. that I think has some inaccuracies in it, but the general premise is still true. Which is that we have no idea how to manage natural parks. We've learned a lot. Anyway, so that system is self-organizing criticality, where if left alone, it will get to a critical point, and there may be a small fire here and a small fire here and a small fire here, until there's a fire that burns out half of the forest. And if left alone, it'll actually do that naturally. There will be big patches that burn and disappear, and then another big patch over here, and then a huge patch over here. And so it continually has this resetting thing where when it hits one of those low probability events that's just huge, it resets everything. So then they associated that with financial markets. Like financial markets pretty much work the same way. They are on a power law distribution. You got the Mag 7 or whatever it is now. I don't know if there's 7 that are just eating up all of the investor money in these indices, and they just keep going and going and going until there's a crash, and then they plummet until somebody comes up on top and you start all over again.
Yeah. Interesting.
So all of these systems tend to some extremity and then fall to way less than their peak and start over. And they also mentioned, which I thought of relevance to you since you're kind of doing entrepreneurial stuff, venture capital is that way. But it's the opposite. Your rare event is the thing that makes all your money. So you are investing in a bunch of things, and most of the time you lose money, but 5% or whatever of your investments, when they 10x or 20x, make all the money.
Yeah,
So that was kind of just what the video was about.
Yeah.
And in general life, like just thinking about what decisions or outcome or what events, if they did not happen, when fundamentally have changed your course of life, it's like 4 things. Like, I've made like 3 big decisions in my life, et cetera, et cetera.
Yeah. What was super interesting, that kind of reminds me of this past weekend. We were in New York City, and we were staying in an apartment that someone I know owns. My wife and I were, but there's a huge tower called Central Park Tower, and one of the penthouses was $128 million. The reason why this reminds me of that is because I was doing the math on how much $128 million would be for Elon versus the equivalent of what that would be for someone who has $250,000 saved. And Elon paying for that penthouse would be the same as someone who has $250,000 paying $75 for anything, which is just the amount of money that he has is crazy. And I mean, like, he's done crazy stuff to be able to make the money, so I'm not saying he doesn't deserve it. I'm just saying, just factually, that amount of money is just a wild amount, which is definitely above the average distribution.
Might be just a little bit above.
Yeah. So
what is his, do you know what his, like that's his full net worth, right?
yeah. But I mean, I know it's mostly in different companies, so it's really not liquid. And him buying $128 million penthouse would actually take more of his liquid net worth, but just in general, the theoretical.
I wonder what his income is or his liquid net worth is.
I can look it up.
Probably never know that number, but yeah, you could see if somebody has an estimate. I'd be curious to know what portion of his money is actually accessible.
Yeah. I mean, he probably takes loans out on stocks and stuff. Apparently, he draws 0 fixed salary from Tesla. Let's see. Although his stock is worth insane amounts. Yeah, it's not.
I guess he sells it in little bits or whatever, whenever he wants to use it or borrows from it.
little bits for him is like sells it in
Uh,
$100 million.
yeah.
No, I'm just kidding.
The the other thing talking about Elon that the video was talking about was that all investments don't function that way, or all businesses don't function that way. I think it was in that where they mentioned like a restaurant, it doesn't operate on the Pareto distribution or any sort of power law, because you can't just have days of no clients and then get all your clients one day of the week or one day of the month. Like there are certain businesses just fundamentally you have to have a steady stream of customers coming in and using your product.
Yeah.
Which to me, I was like, okay, yeah, don't invest in those businesses.
The one, don't invest in the ones that just get it on one day of the week or need a steady.
Right. The steady
Oh,
businesses.
yeah.
I mean, there's in investing, there's always a chance that they franchise and grow that way. But there's also a lot of them that don't get the steady income and fail or just never grow.
Yeah, Amazon's a big failure. Oh wait, no.
Failure.
It's
Failure.
Elon Musk. ChatGPT is not sure what his annual compensation is, but he's worth about 483 billion. So my calculation
Crazy.
for the $75 might even be too high. I probably did like 300 billion or something.
Wow.
Yeah,
Man. Well, ChatGPT is bad with numbers anyway, so
that's fair.
it might be just making things up.
Yeah, so what do you take away from the self-organizing criticality, and what are you going to do about it? Like,
Well, it fits really well into that book I was reading, the Safe Haven book by Mark Spitznagel, where you're trying to look for insurance-like investments to add to your portfolio that give you geometric returns in low probability events. So I'm looking for that long tail, those low probabilities that have high returns. And I thought it was a good sort of discussion of here are systems in real life that run that way. And so then that's got me thinking about how do you detect a self-organizing criticality before a catastrophic event, and then detect and then of course price out. So in my case, if I'm looking for insurance type hedges, how can I find them and where can I find them? So what kind of assets are correlated with broader markets, and what prices do those sell? What kind of leverage are they? Very much the barbell approach of Nassim Taleb, putting 5% in risky stuff and 95% in very stable investments. And I thought the comment of if it's a Pareto distribution, your average always increases the more samples that you take, which then made me think about, is there a way of detecting where you find something that can be traded quickly to have lots of occurrences? And I think in trading, you're looking at the two ways you can do that is trading lots of things, lots of asset classes or whatever, and or your compounding time frame. So I think backtesting is part of how you can find those events. So you're taking the span of time and backtesting across it, effectively simulating a movement through time. And that's how you can kind of evaluate whether you think a system is self-organized criticality. The problem with backtesting is it's not always predictable of the future, as every financial advisor will tell you.
Yes.
Past results are not indicative of future returns.
Yeah, no, that makes sense. Um, what do you think differentiates a self-organizing criticality or like a system that does that from one that's just unstable? And so what would you find differences in like something that does not have cycles? Like how would you know that something has a cycle like that versus just randomly drops? So like if it was
Hmm.
the stock market, how would you know if there's a stock that doesn't just randomly crash versus kind of has a cycle movement and it's okay to invest in as long as you can begin to understand at least generally what the cycle is like.
Yeah. Like how do you know your investment is not going to zero? Is that kind of what you're saying?
Yeah.
Yeah.
Tell us the
Well,
unlock the
when
secret.
when you figure that out, don't say it on here and we'll start a hedge fund. um, I think that in general, the nice thing about an index fund is that it is a much better power law distribution because the chance of just take the S&P all 50 or 500 companies going to zero is basically zero. So you do get that asymptotic curve. If over here is zero, the chances of you hitting zero is nil, and most things are going to coalesce around the bottom end of your curve is going to approach zero, but probably never hit it. Uh, so that's the nice part about a fund. Individual stocks, yeah, I think that's a fair point. Is zero is always an option. Bankruptcy is an option. And some people solve that by diversifying, and other people solve that by finding good companies and holding them for life. But I agree with you. This is not a it's not a perfect scenario in that case.
Is there any specific feedback loops or anything that helps you determine? I guess you can't determine for sure, but at least have a better idea that something is a cycle rather than a random crash.
Mm, I don't know, other than historical data, if there's any way to tell that. My sort of investing thesis, no, that's not true. My investing thesis is somewhat built around there are good companies that exist, and if you know things about them, you can get them for cheap prices. If you don't know things about them, the chance of them going to zero is still there. So you could do what people call catching a falling knife, which is a terrible idea. The stock is on the way down and you think I'm buying in cheap, but if you don't know anything about the company, it could just be that they have a terrible company and they're going bankrupt. So you're putting in more money as it's heading towards bankruptcy. The So that's my trading thesis would be I'm going to trade things and I'm going to get out when price action is bad because I don't have the knowledge to predict when we hit bottom or how low bottom is or how long we're going to be in a downtrend.
Would you realistically say that anyone has that knowledge?
Um, some people seem to be better at it than others, but in an absolute sense, I don't think anyone does. Jim Simons may have been close before he died. I don't know.
What would you say to the people who, so Warren Buffett found good companies and there's a lot of people who follow him. What would you say to the people who are trying to follow him but also don't know as much as him, I guess? I mean, yes, we all start at zero, so he had to learn it somehow. But between determining what a good stock is and what stock might crash, like Warren Buffett tended to invest in good stocks, but he held it for a long term. And so I feel like the longer you hold it, the more chance it is that it could crash because it's just a longer time period. I guess what would your advice be to people who are not investment advice, but just general advice on Warren Buffett's strategy and following that kind of strategy, which is like a long-term play on individual stocks?
Mm-hmm. Yep. You're going to have to know more about the company than everybody you know, and probably most people that you don't know. Like if you haven't looked at annual reports for the company, you probably don't have any business buying and holding like Warren does. I think there's exceptions, but some of those may be just the probability of investing landscapes. Like if you put all your money in a bunch of different companies, surely one of them is going to do well over a period, but it's not because you have any knowledge. It's because you're making somewhat of a relative guess and then buying and holding. I don't know anybody like that. Most people I know that are buying individual stocks are more closer to the trading than buying and holding.
At this point in history, with information basically being almost net zero for most people in terms of like how fast you can get information that other people have other than insider trading, which unfortunately happens all the time. At this point, what is the best way to get an edge if everyone has most of the same information? And I'm not saying everyone looks at all the information, but I am saying that most people have access to the same information that the average investor does. So where do you
Yeah,
look for edges?
if you're an average investor, I think a lot of your edge comes from trading smaller stocks, trading, buying, whatever, investing. Because by definition, you're going to be in a space where the big players can't play due to regulation and capital issues. Once you're buying Amazon and the Mag 7 and anything in the S&P or most things in the S&P, you're already playing with big enough money that you're playing against people who are way more dedicated than you are, which doesn't mean that you're going to fail. It just means it's harder competition.
Do you think that you can become one of the big players by investing in small stocks? Like, let's say someone wanted to be worth 100 million through investing. Obviously, Warren Buffett's worth billions, but do you think that they could do that investing in smaller stocks? Or would they need a different edge?
I think that, yeah, I mean, as long as your capital is sufficient to, what's your time frame and what's your starting capital, I think are two critical points for determining the outcome of that. What is it? There's three, and what's the third? Oh, your rate of return. How much capital you're starting with? How long is your time frame? What's your rate of return? Those are your three predictors of. With a small stock, you oftentimes are looking for a higher rate of return. And it does matter how long your runway is. When do you want to hit 100 million? In 30 years, in 10 years, in 5 years? You're probably not going to do it in 5 years unless you already got a lot of starting capital.
I want to do it in 6 months. No, I'm just kidding.
Right. If you were good like Warren Buffett is, he said that if he was starting over with $1 million, he could probably get 50% a year pretty easily. But there just aren't that many deals when you're playing around with $300 billion of cash.
Yeah. Also, starting with $1 million is quite a lot. But,
well, I think his point is probably amounts under that. He could also, but $1 million being for him, a low number.
yeah, I wish that was a low number for me. It's right.
Me too. Me too.
My thought has been if you can make money in business and then go become an investor, like the Rich Dad Poor Dad
Robert Kiyosaki.
Yeah. What was it? Cash flow quadrant? Was that the one where you
Hmm.
go through like employee and then all the way to investor? Yeah.
Yeah.
That that would really, I guess that's my preferred route, but not that it's any better, but I just think that I've heard a lot of people make money in business and then go become an investor
Hmm.
and
Yeah, that's
build
a
up.
very common, very, very common road. The beginning of the investor side, and also for a lot of people, they're just indexing, is so slow because you've got tiny amounts of capital to work with compared to what your goal is. At getting there, you can do it, but it might take 40 years or 30 years. And if you're wanting to accelerate that rate of return, then you got to figure out other ways of doing it. So yeah, having a business, making it successful, selling it or whatever, and then having a pile of cash to invest gets you there faster. And in Warren Buffett's case, investing was his business. Like he did that. He started with money from a business, but his business was the Buffett partnerships. He did have some of his own, but he had family that wanted to invest their money. And so he started partnerships when they saw he was pretty good at it, and then just continued from there.
Yeah. Interesting. You got any parting thoughts for the audience?
Send us email, jc.unscripted@gmail.com.
Make sure that you if you're on YouTube, like and subscribe. If you're on Spotify, give us a good review and leave a comment. But yeah, that's the pod for today.